This video is about understanding the importance of profit margins when looking at earnings. Okay, so in this video, we will talk about the importance of using sustainable earnings for determining valuations. We'll then show why the variability of profit margins over time distorts the sustainable earnings measure, and we'll show the impact of profit margin assumptions on valuations so that you can appreciate how important this concept is. So why are sustainable earnings important? Well, firstly, earnings are the basic input to most valuation methods. Unless you are using book value or replacement cost to determine value, you will be using some variant of either earnings or cash flow. Now, having a reliable and sustainable earnings number is essential. One great year of earnings does not mean sustainable. So if you were buying a business and it happened to have a great year this year, you wouldn't value the business based on that particular year's earnings if it was not sustainable. If a lender were going to lend you money for the investment, they would want to make sure that you could service the debt going forward, not just based on the most recent year. And the same concept applies to the S&P 500 or the total market. So this is what profit margins after taxes as a percent of GDP look like over time. And you can see right away that this is not a stable number. It has varied from a high of around 10% going down as low as 4%. And so you can see where we were at today. We're at just under 9%, and we're actually down from the highs of around a little over 10% over the past 8 quarters. The question is, what is normal? So you don't want to rely on an earnings number when profit margins are at the high end of the range, because we know that is not likely sustainable. So it's important to be cognizant of where profit margins are in the cycle. And so this is the same graph showing corporate profit margins, and we've just overlaid the long-term 50-year average, which is shown by the green line, which is at 6.46%. The red line is a 20-year moving average, which is currently at 7.77%, and the current reading is at 8.88%. Now we know that profit margins will generally mean revert over time. The question is, what will they revert to? In other words, what is a normal profit margin number? Will it revert to its long-term historical average of 6.46%, or do profit margins go through secular phases and where it may not be realistic to expect it to revert to its long-term average? The other issue is that when profit margins revert, they can tend to overshoot the mean and then come back to it. So these are all issues to think about to get comfortable with your valuation. And here's why this is so important. Let's just look at a simple calculation of the impact of profit margins on valuations. We have a sales or GDP number of $100, and we have 3 different profit margin levels. The first column is our current level at 8.82%. The second column is the 20-year moving average, and the third is the 50-year long-term average. At current margins, earnings would be $8.82, and at a PE of 17, we would have a value of about $150. If we use the 20-year moving average of 7.77%, that would imply a value of $132. And if we assume the long-term average of 6.46%, we would have a value of $109. So clearly that's how important profit margins are, because a small change in profit margins has a very big impact on valuations. And importantly, the higher the PE ratio is, the more sensitive valuations become to changes in profit margins. Now, just a small technicality, if you are assuming a mean reverting process that may take, say, 3 years, then you would technically have higher earnings for those 3 interim years until it mean reverted. So that has some extra value, perhaps a 2 times multiple, but definitely not a 17 times multiple for those incremental earnings. So in conclusion for this segment, don't take earnings at face value. Understand what is sustainable and not just what the most recent year's earnings are. And profit margins are an important contributor to this calculation. And secondly, there is no consensus on what normal profit margins are, and so we need to explore the components of profit margins to get a better understanding. We're out of time for this video, but please see our next video called Profit Margins, What is Normal, where we will delve a little deeper into understanding the components of profit margins.